Alphabet reported earnings last week, and the results were pretty good in light of the current economic climate, especially in the advertising space. And so that's what I want to dive into in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and let's get right into this one. So you can see that on a 1-year basis, Apple stock is actually down 10%. However, on a year-to-date basis, it's actually up 20%. And it really just speaks to the fact that a lot of securities were really beaten down near the end of the year, and a lot of names have sort of surged upwards. And I think part of that is just because everyone was kind of expecting sort of like the recession to start in 2023, and it never really came. And so, stocks started to rebound as a result. Now, it's really funny, this recession, everybody's kind of predicting it, but it's just not coming. And so, we'll see how these things play out down the road. But I think we have to be a little bit realistic when it comes to our valuations. I think I even got caught up a little bit in thinking that, the recession is around the corner. But, when it comes to valuations, once again, just got to be a little bit more realistic and put the fear to the side, I guess, a little bit. And one of the things that's really important to consider is the fact that, these financial statements that we're using to build out our models and forecast these companies forward, they're backward looking in nature. And so these companies can do or execute certain projects that could make them more profitable. For example, Google is all about cost control now. And so, it's shuffling costs more appropriately between its segments. That doesn't necessarily help its bottom line. However, they're also in the process of layoffs or just making their operations more efficient. That once again is actually helping the bottom line as well. And so we're seeing this happen, but not necessarily just at Alphabet. We're also seeing it at Meta. They're saying that it's the year of efficiency for them, et cetera, et cetera. You've seen this right across the tech space. And, it's something that I've spoken about many times on this channel. Okay, and let's dive right into their results. So you can see that they actually took $2.6 billion in charges, but that's a result of their ongoing efficiency measures as their, the commerce in general is slowing down industry-wide in the tech space at least. And so, there was a shift in stock-based compensation awards. So, you might get lower costs in the quarter, but it'll pick up through the end of 2023. And so they're even telling you that the shift in the timing itself will not affect the amount of stock-based compensation expense over the full fiscal year of 2023. So just pay attention to that as you guys calculate your free cash flow figures. Net of stock-based compensation for the quarter, always adjust for stock-based comp. That's how I do it in the model. So if you don't know how to do it, join the Patreon and look at any one of the models for any one of the companies, and you'll see that's how I do it. Now, interestingly enough, notice revenues for the quarter are actually up 3% and 6% on a constant currency basis. This is quite exceptional considering that the advertising or the digital advertising market is challenged in the current environment. And so, you're seeing companies like Snap report not as exciting results as you'd want to see. Meta is reported higher revenues, but they also told you that they were pushing heavily into sort of like blue ocean opportunities as it related to their AI. And so you saw that Meta was going to come out with better results, but Alphabet, I didn't really know how they were going to do. So it's really nice to see that revenues were up overall. Now let's dive into the $69 billion figure, or I guess $70 billion figure, and see exactly where the revenue growth came from. And you're going to see that it's a really good news story because the story is all about cloud. So you can see that Google search is up 1%. YouTube is actually down 2.6%. And this is a big problem, but I'll explain this in more detail in a bit. And then of course cloud is up 28%. So the reason why they had really good results in the quarter is just that cloud is even outperforming my expectations. And do I think that cloud can continue to outperform? Absolutely I do, but I do slow it down in my forecast as well. The fact that search is up at all is very exciting to me, because if search is up for Alphabet in this market, then I expect it to rebound considerably in 2024, and that's kind of how I'm modeling it out. Now, I could be wrong. There could absolutely be a deep recession in 2024 or late in 2023. We don't know, but that's kind of when I saw this, I thought to myself, they absolutely outperformed where I thought they'd be. I'm a little bit worried about YouTube, but the thing is, last year I forecasted 2023 as YouTube results to be down 5%. So the fact that they're only down 2.6%, they are actually outperforming the model, and I'll show you that in a second. Now, there is a problem with YouTube slowing. And the problem is that Alphabet's growth story is really a two-pronged growth story. It's YouTube and then it's cloud. And then, they have their legacy search product. But, the whole reason why Alphabet has had a higher multiple is because YouTube has been growing fast and cloud has been growing fast. So if one of those avenues of growth goes away, then you have to reconsider the valuation, which is what a lot of people have done. And it's why you're seeing Alphabet trade lower in this environment. So, I say it right here, YouTube has historically been a very fast growing segment for the company. So the fact that it's slowed is very concerning because it puts into question how we should be forecasting this segment out into the future. Now, I personally remain cautiously optimistic, but I have brought my forecast down. So you can see here, the way that I'm thinking about YouTube is this is actually unchanged from last year. So anybody who's been a part of the Patreon and you've been looking at the model, I've actually not changed the model at all on Alphabet. It's the same since their annual reporting. And so you can see that I still expect YouTube to get weaker. I might change this to negative 2.5. We'll see. I mean, I might actually do that. I do expect a resurgence for YouTube in 2024, and then I expect it to sort of like stabilize at a 7.5% growth rate thereafter. But here's the problem. If this is the trajectory for YouTube, then the company's just worth a lot lower than what people are currently hoping that it's worth. And so this is a problem type of valuation. And I'm going to explain how YouTube can blow through these numbers in this video. And so let's talk about that next. So I always encourage you guys to read or listen to the conference calls, like read the conference call transcripts or listen to the conference calls. And so, they laid out their strategy for YouTube, and they're focusing first on continuing to grow the shorts business. So I mean, if you're a creator, focusing on shorts is very important because management is telling you that they're trying to focus on shorts. Now, I don't do shorts on my channel, but that's something that's sort of like lacking, I would say. Now, the next area that they're focusing on is CTV engagement. If you haven't heard of what CTV is, this is called connected TV. And so they want more and more engagement on this offering, and I'll talk about this more in a second. This is sort of like they've created sort of like a YouTube channel and stuff, but I'll dive deeper into that in a second. The third area that they want to focus on is investing in subscription offerings. And then finally, long term, they want to make their ads shoppable. So this is a great strategy, a great framework that they're building out right now. And so here's where they talk about it. First, they go into shorts. So they're seeing strong watch time and growth. People are engaging and converting on ads across shorts at increasing rates. Now, here's the thing. If people are engaging and converting on ads that they're starting to show on the shorts, what happens when they start making those ads shoppable? Those ads immediately become way, way, way more valuable, and that will lead to YouTube making a ton more money. And so that's kind of what we're looking for here. Now, the second area is connected TV. So, they love watching, or viewers love watching YouTube creators on the large screen. And so, you're just getting better content as time goes on, like Mr. Beast type content, etc. And so here's the interesting part. Based on what device you're viewing the YouTube video on, they will serve you different types of advertising. Now, I've been testing this, and I've been putting videos that I watch on my TV using my Google Chromecast, and I've noticed that I'm getting better advertising as a result of watching the content on my TV. And so it's very interesting that they're following this strategy, and you can see that the premium advertisers are leaning in. Like, I'm getting auto ads and sort of like beer ads, and maybe not beer, but like I've definitely seen auto ads for sure. And it just speaks to me that that's like a more premium type of advertiser. And so I think this is working. I think it's just at the early stages. And so, these are two areas, shorts and connected TV, which can provide an immediate growth of advertising revenue for the platform. So here's where, I think about that, resurgence of advertising spend for YouTube in 2024. I think as these things get built out, as advertisers get more used to it, as advertising firms get more used to it, it will work in their favor. And so that's why I've sort of like valued in a bit of a surge in 2024, which I will show you in a second. Now, the next two are areas that are building out as time goes on. So the more immediate one is the subscription offerings. So they want to be a one-stop shop for multiple types of video content. They just launched YouTube TV. And, when you subscribe to YouTube TV, you can a la carte purchase any NFL Sunday ticket. So that's pretty interesting. And I guess YouTube TV I don't have it in Canada, so I can't really test it out. But when I do go to the States, I'm gonna try and play around with YouTube TV and see what it actually looks like. But I'm just assuming that it's just a TV subscription, so like cable subscription. So that's pretty interesting. I really believe that they should continue to go aggressive on sports. NFL Sunday Ticket is a good start. The other area that they can probably dive into further is look, one of the largest creators on YouTube is the WWE. Why can't you go aggressive and get Raw or SmackDown or whatever? It gets a lot of views, and it aligns with the strategy of going aggressive on sports. I understand that it's not really sports, but it's in that same sort of area, I would say, of a sports related or sports entertainment related content. So NFL, NHL, college, everything. They should really go aggressive on sports. YouTube should become the place to watch sports. TV's going away, and so I think that's the move there, and that will increase the number of people that are subscribing. The only reason why many people subscribe to cable is just to watch sports, right? And so if you can tell someone that, hey, you can get rid of your $100 per month cable subscription and just pay $10 a month and you get access to all the sports on YouTube, I mean, that's a pretty compelling offering. And so I think that, in the medium term, this will pick up for them. And I'm not valuing it in specifically, but it is something that I'm watching, and I need to learn a little bit more about YouTube TV. Finally, this is the one that will double, triple revenue on YouTube, I believe. Now, they're saying that it's still early days, but they are saying that over 100,000 creators have connected their own stores to YouTube channels to sell their products. I don't think, yes, this is fine, but I don't think this is the focus. I think, and they've spoken about it before, is making YouTube ads specifically shoppable. And here's sort of an example, and I think I've mentioned this on the channel before. So you get a 15-second preview for a new movie that's coming out, and then at the end of the ad, there's a clickable button that says, hey, if you want to see the full trailer of this movie, click right here. And every time somebody clicks to watch the full trailer, that's an additional monetization fee, that's an additional fee that YouTube charges the advertiser to show that trailer. And so that's an area, or that's a type of opportunity that I see for them. You're not seeing it really happen yet. Tell me if you guys are seeing something like that in the US. I'm definitely not seeing it in Canada. And then the other area, of course, is somebody serves you an ad, but while you're seeing the ad, there's a button to shop now. How great would that be if it sort of connects with Amazon, and Amazon uses your sort of browsing history and knows which products that you would be interested in, and they have ads that align with that product, and they serve that ad to you while you're watching YouTube, just to remind you that that's something you were looking for anyways, and then you can shop right there. And so I think that becomes very valuable. I think it's very sophisticated to do that. I think it'll take some time to build out, but I think it becomes very, very valuable. And so overall, I think YouTube does have the ability to outperform the way that I'm valuing it, but let's see how this plays out now. Cloud is actually starting to generate a profit, but don't be fooled here. They just shifted expenses in order for it to generate a profit. So, I'm not going to speak more about this, but yeah, it's a small profit, but revenue growth is really the focus for cloud at the moment. And you can see them speaking about it here. Google reshuffled some costs. Now, this is from a Wall Street Journal article, by the way, but Google reshuffled some costs from its cloud business to its core operations, which it said was done to provide our business leaders with increased transparency for decision making. As a result, Google Cloud showed its first ever operating profit of $191 million for the first quarter. Now, Google does still have a long way to go to make the same amount of operating profits that Amazon does, and so it's still a wait and see. for the growth of this segment. Now, the other thing of note is, when I spoke about efficiency early on, so, the company's headcount account of 191,000 people doesn't yet reflect the laying off of 12,000 workers that was announced earlier this year. And so most of that will be done in the current quarter. And, as a result, Wall Street analysts expect the company's operating income growth to pick up this year and resume its double-digit pace by next year. Now, I don't see double-digit growth, but I tend to be a little bit more pessimistic, but my eyes are open. I'm waiting to see this pick up. And once again, I do believe that they will likely outperform the way that I'm forecasting YouTube, or the YouTube segment at least. But once again, I'm going to remain a little bit, conservative in the valuation for that segment. Now, when it comes to the cloud business, I tend to be a little bit more optimistic. So I'm forecasting a 20% growth rate for this segment right across the board for 5 years, and then I slow it down thereafter. And part of the reason why I do believe that cloud is going to grow at this rate, at a sustained rate of 20%, which is pretty high, is because just the relative size of Google's cloud offering compared to Microsoft and Amazon. I think they have the ability to take market share as well as just grow in line with the industry as well. And so the industry is growing at a rate faster than 20% overall anyways, and so I think they hit this. In fact, I think they outperform. I mean, this past quarter they did 28%. So will they do 20% for overall for 2023? I think so. Like, if you were forecasting 25%, I wouldn't bat an eye, at least for 2023. I mean, you could bring it down to 20% thereafter, but essentially what I'm saying is that 20% seems high, but then when you see what's actually happening on the ground in real reality, it almost comes off as like a little bit low. But I don't want to be too optimistic here. I think 20% is optimistic enough. Now, I speak a lot about Alphabet and my belief that it is somewhat undervalued in this environment. And in order to get access to sort of like what I think it's worth, and compare sort of like my valuation with your valuation, please consider supporting the Patreon at that lower tier, which is just $5 a month. And it'll unlock sort of like the intrinsic value, and then every day it updates and shows you what the intrinsic value is as a percentage of the current share price. And so it's a very exciting or a very interesting way that I've built out the tracker. And so every day you're getting an update, and so you can sort of see what stocks seem undervalued. You may not agree with the intrinsic value calculation, and that's okay, but you can also use it to build your own tracker, and so that's why it's valuable. And so if you're interested, you can join us and get access to the research tracker at the lower tier, and there's over 200 people that are presently a part of the team, and so it's very exciting. Now, the other thing is, this Saturday we're actually having our monthly live call where I present a research presentation live and discuss the opportunities that I'm seeing in the market. Many interesting opportunities have come out from these calls. Also, we have special live courses. The one that I recently did was on the regional banking industry, and I think I'm going to do one more on that, and then I'm going to go into things like how to build your own tracker, etc. And then of course the comp schedule relates to right now the comp schedule is the regional banking industry, but I'm going to add more to this. I'm going to add in the insurance companies. I'm going to add in one for retail, one for real estate, dividend type companies, etc. And so there's going to be more and more stuff built out here. And so if you want to join us for our live monthly calls, the comp schedule and the special live courses, I think this is the best value on YouTube, and you can get to that at $15 a month. Now, the other thing that I do like to offer, and I've been saying it quite a bit on all of my videos, is I think that the best value that I'm offering on this channel is the Q&A series, where I take interesting yet somewhat complicated concepts and try to break them down as much as I can. And so if you haven't seen the Q&A series, no problem. I'm going to link the whole series right here.